I'm not saying that gold's going to go to 3,600. I am saying it wouldn't shock me if it did. The downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends. Leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. The trigger was the dollar shortage, so it was sell gold, get dollars to buy oil because you need the oil. Central bank buying, flat mining output, inflation concerns, uncertainty, etc. Gold should go up. Late this year, early next year, $10,000 an ounce is still intact. Well, why are they buying this gold? No, yes, gold did surpass treasuries as their percentage of total reserve assets. The Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold. Physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. Euroclear and Citadel, DTC. The Russians had 200 billion out of their 300 billion in custody at Euroclear in Belgium.
I want to kick the conversation off with gold and silver markets as we see gold around 4,000, silver around 60, a fairly dramatic correction so far after both metals hit all-time highs in January, although they seem to be bouncing back somewhat today as we speak. I believe silver up close to 4%. Well, what are your thoughts on this recent price action? And is this a buy the dip opportunity or a time to exercise caution in your view?
I'll give you a longer explanation, Jesse, but the short answer is it is a really good entry point, buy the dip opportunity if you want to put it that way. Of course, I watch it closely, and you're right. End of January hit an all-time high. It was 53, 55. That was a closing price. You can get different numbers intraday depending on what ticker you look at, but call it 5,400 for a round number. But I think the ticker I use said 53, 55. It's down around 4,000 an ounce. It dipped a little bit below that. It was a three handle there for a while. It was like 39.50, something like that. But you're right. It seems to have settled in around 4,000. So we all see the price action. The question is, what is this? Did we hit a peak? And was that a bubble or a hyper spike? And now it's going to keep going down and get out while the getting's good, etc.
Jim Rickards note that pulling back from record highs is normal commodity behavior rather than a sign of a failed bull market. The real question is whether average investors are reacting to scary headlines while central banks quietly buy up assets during the weakness. Those who mistake standard volatility for a total collapse often give up their strongest long-term positions. Looking ahead, Jim Rickards explains exactly why this current dip may actually strengthen the long-term case for significantly higher gold prices.
Or is this just how it goes? Is this a normal, I'll say normal, like not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I am sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact. Now, that's easy to say, but let me kind of look behind the curtain a little bit and kind of analyze that. The fundamentals have not changed. When I say fundamentals, uncertainty in the Persian Gulf, uncertainty in the war in Ukraine, central banks are still net buyers. China's buying hand over fist. Mining output is flat. I'm not saying peak gold in terms of mining, but when you have flattish supply and rising demand, that's a recipe for higher prices. And pardon me, we can all see what's going on with inflation. So none of those fundamentals have changed. So what did happen? Well, a couple of things. Number one, when the war in Iran broke out at the end of February, but you can kind of see it coming, they shut the Straits of Hormuz, and there was a time it was a double blockade. Iran was blockading the Straits, and the U.S. Navy was sitting out in the Arabian Sea. So Iran didn't let anybody through unless you were a friend of Iran or China and you paid a toll.
According to Jim Rickards, persistent inflation, steady central bank buying, limited mine supply, and rising geopolitical tensions continue to support gold despite its temporary weakness. Markets frequently price in fear long before the actual fundamentals unfold, creating confusion that rewards patient investors over emotional traders. Ignoring these deep structural trends could end up costing you far more than simply enduring short-term volatility. Moving forward, Jim Rickards exposes the overlooked chain reaction directly linking geopolitical conflict to the gold market's next major move.
But if you met those criteria and you got through, the U.S. Navy was waiting outside to board your vessel, blow you up, and turn you around. So how many people in the world were friends of both? The answer is nobody. You were either pro-Iranian, then the Navy stopped you, or you were anti-Iranian, and the Iranians stopped you. So it really was shut off. And I don't have to recite all the statistics. We all, 20% of the world's oil, 20% of the world's liquid natural gas, the larger percentage of sulfur. People are like, what the heck is sulfur? I mean, they know what it is, but like, why is that so important? It's a precursor chemical in just about every important chemical process you can think of. And then also a major source of helium. Like, yeah, you blow up party balloons. No, yes, but you need helium to make semiconductors. So, and then aluminum, and then nitrogen, nitrates to make fertilizer to feed the world. The implications of this are mind-boggling. Again, people have been through that for the last couple of months. Some vessels are getting through right now, but not that many. Even on a good day, it's less than half the prior traffic. So the idea that, the coast is clear is just not true. Now, what does that have to do with the price of gold? The world needs oil. Now, there is oil around. The U.S. is not going to run out of oil. We have seen higher prices. We're not immune from a world price. But we're a net exporter. We got plenty of oil. We've taken over the Venezuelan oil. We're good friends with Guyana, right next door to Venezuela. They might have larger reserves than Venezuela for all we know. So we're still exploring that. We kicked the Chinese out of the Panama Canal, and Trump's opening up leasing opportunities for oil and natural gas on federal lands, the Gulf of America, Alaska, and elsewhere. So the U.S. is not going to run out of oil. Neither is Russia. But they don't have enough to supply what's missing from the Persian Gulf. So will we send some to Japan because they're friends of ours? Yeah. But what does that do for Malaysia and India and, in Africa and Europe, for that matter, and other places? The answer is not much. Russia could supply all the natural gas Europe needs, but the Europeans just seem to be intent on economic suicide, basically cutting off the Russians for no good reason. So again, how does that affect gold? Well, the answer is all of those commodities I just described are priced in dollars. They just are. And if you want those commodities and they're in short supply and the price is going up, you need dollars, and the price goes up more, you need more dollars. Well, how do you get dollars? Well, one way to do it is to sell gold and get dollars. So that created the downward pressure. In other words, countries, I said central banks are net buyers, and they are, but some countries, including Turkey, Russia to some extent, China and others, sold gold to get dollars to buy oil. So the downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends, all the things we were just talking about. It had everything to do with the fact that the world was short of dollars and needed them, and one way to get them quickly, because it's liquid, is to sell gold. So that starts the downward price pressure. Then it feeds on itself. So all of a sudden, leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. They're like, hey, it's going down, sell more. And then you hit more stop losses. It feeds on itself, and it keeps going down. So the trigger was the dollar shortage. So sell gold, get dollars to buy oil because you need the oil.